Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me. I'm really excited to dig into this one.
Yeah, so the mission of our deep dive today is to explore this really fascinating real-world economic experiment that's, happening right now in Asia.
Right.
According to recent analysis, we've got two major economies, the Philippines and Japan, and they're both getting hit by the exact same problem.
A massive global energy shock.
Exactly. I mean, skyrocketing oil prices, just wildly expensive energy. But what's crazy is that their governments are using completely different, almost opposite playbooks to fix it.
Yeah, and for you listening, even if you're an American who was just a beginner to economics, this is why you should care.
Right, because it sounds far away, but...
But it's not. Watching how these two countries handle incredibly expensive energy, it teaches us exactly how global markets, currencies, and government policies actually work in the real world.
It's like seeing the machinery under the hood.
Exactly. It strips away all that boring textbook theory and just shows you the raw mechanics.
So to make this super clear, I want to introduce a simple analogy for you guys. Imagine a severe heat wave.
Yeah.
That heat wave is the global energy shock. It's hitting everyone. Now, the Philippines is dealing with it by basically upgrading their house's entire electrical grid.
Which is painful and expensive.
Right. They are raising interest rates. But Japan is doing something completely different. They're just standing on the porch, calling their neighbor to borrow a giant fan.
I love that.
They're coordinating with the U.S. and using currency warnings. So let's look at the electrical grid first. The Philippines playbook, hitting the brakes to stop inflation.
Yeah, the data here is actually really striking.
It is. So looking at the recent data, on April 23, 2026, the Philippines Central Bank, which is called the BSP, they raised their main interest rate by 25 basis points to 4.50%.
Which is a pretty significant move.
And real quick, just for the beginner listener, whenever you hear financial people throw around the term basis point, it's literally just 0.25%.
Right.
Like 1 basis point is 0.01%. So 25 basis points, just 0.25%. They made borrowing money slightly more expensive.
But the why behind that decision is, well, it's terrifying if you're looking at their domestic numbers.
Break that down for us.
So in the Philippines, diesel fuel prices have surged by 59.5%.
Wow. Almost 60%.
Yeah, and gasoline is up 27.3%.
Yeah.
So because of this, literally everything that needs to be transported is getting way more expensive.
Because trucks run on diesel.
Exactly. The data shows transportation costs alone are up 9.9%, and that is pushing overall national inflation to 4.1%, which is outside the central bank's comfort zone.
Okay, so wait. Let me push back on this, because I think this is a foundational question for anyone trying to understand this stuff.
Yeah.
If the problem is that crude oil coming out of the Middle East is just super expensive right now, how does making it harder to get a mortgage or a business loan in the Philippines fix the price of gas at the pump?
That is the perfect question. Because obviously the central bank in Manila can't make oil cheaper.
Right. They don't drill for oil.
Exactly. What they are actually doing is fighting what economists call second-round effects.
Second-round effect.
Yeah. So the initial surge in the price of oil, that's the first-round effect.
Mm-hmm.
The central bank can't stop that. But what they can do is stop the panic.
The panic of everyone raising prices.
Right. Imagine you run a bakery. Your
Yeah.
delivery costs just went up 60%. So you raise the price of bread. Then your cashier sees the bread is more expensive, her bus fare is higher, so she demands a wage increase.
And if she gets that raise, the bakery's costs go up again.
And then you raise the price of bread again. It's a spiral. The central bank raises rates to slow the whole economy down, so businesses literally can't afford to easily pass those costs along. It breaks the panic cycle.
So they are essentially engineering a slowdown, upgrading that electrical grid, even if it disrupts the house for a bit.
Exactly.
Yeah.
And they have to do this because global credit agencies are watching. Fitch actually just downgraded the Philippines' credit outlook to negative because of this vulnerability.
Oh, wow. So they are really under the microscope here.
They are.
But according to the research, it isn't all bad news for the Philippines. There's a pretty massive silver lining here.
Yes. Looking long-term.
Right. The data shows that JP Morgan is adding Philippine government bonds to this major global index called the GBI-EM starting in 2027.
Which is a huge deal in the financial world.
Yeah, so think of it this way. Imagine a highly rated local, like, neighborhood store. They do great, but they only get local foot traffic.
Right.
Getting added to this index is like that local store suddenly getting put on a massive global delivery app.
That's a great way to put it.
Suddenly, people all over the world are just automatically buying from them. In the financial world, foreign money will structurally flow into the Philippines over time just because they are on that app now.
And that acts as a huge shock absorber. It proves that the short-term pain of raising rates,
The upgrading of the grid.
exactly, it's worth it because they are securing that long-term global investment.
Okay, so that's the Philippines, slamming on the brakes. But let's smoothly pivot over to Japan, because Japan is doing something completely different.
Night and day difference.
Right, because Japan's biggest fear right now isn't actually just inflation, it's the collapsing value of the Japanese yen.
Yeah, the yen is hovering dangerously near 160 to the US dollar,
Right.
which is incredibly weak.
So instead of raising interest rates right away like the Philippines did, the Bank of Japan is actually expected to hold rates totally steady at their April 27-28 meeting.
Right. No rate hikes.
Which introduces our next cast of characters. Japan is using, like, the power of verbal warnings and international teamwork instead. Specifically, Japan's finance minister, Satsuki Katayama.
Yes, and this is where the U.S. connection comes in, which is crucial.
Yeah, looking at the data, Katayama recently met with Scott Bessent, who is the Treasury Secretary under the current Trump administration over in Washington.
And the reports say Japan and the Trump administration are basically coordinating 247 to issue these severe warnings to currency speculators.
Which brings me to another analogy, the bouncer at the door.
Oh, I like this.
Right, so instead of actually throwing a punch...
Which would mean spending billions to buy yen or shockingly raising rates.
Exactly. Instead of throwing the punch, Katayama and the Trump administration are just standing at the door of the club. They're flexing their muscles and loudly warning speculators that they'll take, quote, decisive and strong action if the market gets out of hand.
They are hoping the threat of the fight is enough to scare the speculators away.
But let's clarify something here, because I think a lot of people misread this. When Japan coordinates with the U.S. Treasury, they aren't asking for a new loan to fight this battle.
No, not at all. And that's a huge misconception in the market.
So how does it actually work?
Japan already has what's called a standing swap line with the U.S. It's basically a massive emergency dollar account.
So they already have the money.
Exactly.
Yeah.
They aren't asking for a new one to fund this fight.
Yeah.
They are just using the threat of their existing massive dollar reserves to scare off traders.
Basically saying, hey, we have an unlimited war chest of U.S. dollars right here, and the U.S. government is standing right next to us. Do you really want to test us?
Right. It's entirely psychological warfare. They are protecting the currency with words and coordination, so their central bank doesn't have to hit the brakes on the actual economy.
Okay, so let's pull all the way back and look at the big picture here, connecting the dots from everything we've talked about. According to this recent analysis, when you're watching global markets, you just can't assume that high oil prices means every country reacts the same way.
No, absolutely not.
The Philippines is protecting its domestic prices. Japan is protecting its currency's stability.
Because the structure of their economies is completely different.
So let me ask you this. If I'm an everyday American investor, just looking at this, what does a super weak yen actually do to Japanese companies? Is it a good thing or a bad thing?
Well, it's really a two-faced situation.
Two-faced. How so?
So a weak yen is absolutely fantastic for massive Japanese exporters. Think of the giant car companies.
Right, because they sell cars in the U.S. for dollars.
Exactly. Their products become cheaper overseas, and when they bring those U.S. dollars back to Japan, they convert into a mountain of yen because the currency is so weak.
So they're just swimming in record profits.
Huge profits. But, and this is the dark side of it, it is terrible for regular Japanese citizens and local businesses.
The domestic side.
Right. Think about a local utility company or a domestic bank in Japan. They have to pay for imported energy, like that expensive Middle Eastern oil, using a terribly weak currency.
Oh, wow. So they are getting squeezed from both sides, high oil prices, and their money is worth less when they try to buy it?
Exactly. So your grocery bills go up, your electricity bill goes up, the exporters are cheering, and the regular citizens are really struggling.
Which brings us to the core lesson for the listener today. You can't just randomly buy Japanese stocks or Philippine bonds based on, a single news headline about oil.
You really can't. You have to look under the hood at the combination of tools a country is using.
Right. In the Philippines, it's a mix of higher interest rates right now, paired with new foreign investment rules bringing a safety net by 2027.
And in Japan, it's a mix of the central bank hitting pause on rates while the government aggressively talks up the currency with U.S. support.
It's all about how they use the tools they have.
But, it does leave us with a pretty intense thought to end on.
Yeah, lay it on us. What's the bigger picture here?
We've just spent this time seeing two countries stretch their economic tools to the absolute limit just to handle the current price of oil, right?
Yeah, the Philippines maxing out the brakes, Japan relying on the bouncer at the door.
So if geopolitical tensions rise and oil prices suddenly double from here, what happens when countries run out of bouncers and brakes?
Oh, man. That is a scary thought.
Do we see a totally new kind of global financial crisis? One where governments just literally don't have the tools to fix it anymore?
Wow. Yeah, that is a lingering question we all need to be pondering as we watch the news over the next few months, because machinery is already running red hot.
It really is.
Well, thank you all for joining us on this deep dive to figure all this out. Don't forget to subscribe and hit that like button.